Well, it was an interesting week, as much for the actual movement on the market as the emotional responses that we've seen to them. What I've done here is I've just tabulated the daily returns for NASDAQ 100, S&P 500 and the All Ords for last week. There's no data for the All Ords on the Monday because of our public holiday. And you can see not the best of weeks, a little bit topsy-turvy. A single positive session in the US. We didn't manage a positive session all week. But what is interesting about these sorts of events as they unfold is the responses that they generate. And the responses they generate are out of proportion to the events themselves. Yes, markets are coming off, and they're coming off quite sharply. But that happens when you get to the end of an asset bubble in everything. So, for those of us who are ancient, this is not unexpected. For those of you who came to markets fairly recently, this is probably all a little bit of a shock. And in that basket, I would put financial journalists. These are simply 4 headlines I snipped at random before putting this together. And you can see the notion of panic creeping in. You can see the breathless hyperbole that is a driver of all media. It is this notion that if you generate a fear response or an emotional response, you're somehow doing your job. The problem with this sort of behaviour and this sort of commentary, these observations, is that for many, they are not only self-serving, but they become self-reinforcing. So that what happens is that when people come across markets in distress, they catastrophize everything. They believe that this is the only state of affairs that will ever exist, and everybody's mind naturally goes back to 1929, when images like this were somewhat commonplace. They believe that the end of the world is coming, and the world will never be the same ever again. And you might think that that is an overblown observation. But consider this. It was only 2 years ago that we had women punching on in supermarkets over toilet paper because their view, the view they had taken on and internalised, was that supermarkets would forever look like this, where there was no toilet paper ever again. When in actual fact, supermarkets today look like this. They actually have things on the shelves. Now granted, because of supply chain issues, you might not be able to get your favourite Burgundian wanker cheese, which is such a crowd pleaser at your fondue and wife swapping nights, and lettuces might be outrageously expensive, but there are still things on the shelves. The world did not end. Just like with the current situation, the world will not end. This is a quick list of the financial events that I have seen in my career. Here's a shock for you. They came to an end. There came a point in time when the distress ended, prices went up, people moved on. The world simply did not stop. So as a subtext or sub-theme to this, it is the notion that there are always opportunities. Granted, there are no opportunities in stocks at present, according to the way I see the world. And I'll touch upon that again in a moment. But if we look to the longer-term history of the Australian market, we can see that the current drawdown of about 15% pales into insignificance compared to the GFC, where the market halved. Not only did we halve, the S&P 500 halved as well, and the NASDAQ lost about 78%. But there's a caveat here, and it's an important one that people miss. This is an index. An index is a carefully crafted bunch of stocks. It's an aggregate. Financial planners and stockbrokers unfortunately engage in this intellectual dishonesty where they will put up this chart to a client and say, markets always go up. The implication is that your stocks within the index will also go up. That's not true. If, for example, you own one of these, let's use the technical term dogs, that I collated from the All Ordinaries, your chances of seeing a profit in the near future are slim to none. What I've done here is I've looked at the 1 year change in these stocks. I've then looked at the percentage gain on the current price required to get back to that point. You will see a company like Zip in a single year has lost 93%. To get back to that high 1 year ago will take a gain of 1,272% on the current price. And you can see some very, very, very familiar names in here. These sorts of gains do not occur overnight, if ever again. So if you've not taken any action during the fall in prices of these things, technically you're stuffed. And that's an important point. The important thing here is that markets tell you a story. You can see here that Zip peaked in early 2021. You've had a year and a bit to get out. You've had a year to take your money and go. Same is true of PointsBet. It peaked also in early 2021. And the market constantly offered you an opportunity to exit. And most people did not. But you might say to yourself, well, look, these are second and third tier stocks. Some of them are rubbish. But I would posit that something like Magellan Finance is not. And there's a twist in this chart. The 1 year high refers to that high at $55. It does not refer to the high in 2020 at 75 and a bit. If you were to take the drawdown from the $75 and not the 55, your gain to recovery would look a lot worse than it does at present. And there will be people who entered at 75 who are still holding it. The thing about Magellan is people who are holding it now have lost almost a decade of gain. This is despite the market telling them that they can actually do something. You can actually sell a stock. You can actually move on. This brings me to a very important point. To take no action is actually an action. You have elected for a set of behaviours that have got you into this position. It's not as if it has just happened. You are an active participant in what is occurring. All of us are active participants in all of the events that undertake us, bar the most extreme of random events. Your interaction with the market is a two-way street. The market does something, you respond. And your response must be in line with what is occurring in the market, not what is occurring in the land of wishful thinking. But the story is not completely negative, because when markets draw down, they present an opportunity. They present things that will happen in the future. I'm not saying this is happening now by any stretch of the imagination. I can see of no conceivable reason why at present you would buy any stock anywhere in the world as markets continue to draw down and as they continue to deal with this new economic reality that we have. But this is a case in point. And yes, this is an n=1 experiment. It is also a survivor bias experiment to a degree. But Apple itself in 2008 drew down 50% in price, as did many other issues in the Nasdaq. But within 3 years, 4 years, it had gone up tenfold. But the problem is, if you have done all your dough by not taking corrective action, when this sort of thing's occurring, when you're stuck in these sorts of stocks, this opportunity will pass you by because you have no money. You simply are not in a position, financially or probably emotionally, to see this as an advantage and to do something about it. But that's enough about the history of markets and some of the histrionics that are going around it and the over-emotional gnashing of teeth that's occurring. In terms of things that are of interest to me, I mentioned a few weeks ago in the Talking Trading Market wrap that I'd been looking at the US dollar yen. One of my systems that trades over a very short-term time frame fired a short trade, which I took. It ended in a tiny loss because the breakdown didn't continue. Markets reversed. We now have this situation where US dollar yen is bookended. And I must admit, I find these patterns fascinating. It's simply because of the unfolding of psychology within them and the fact that when they do break, they generally break very, very strongly in one direction or another. So this sits in the back of my mind as one of the things I'm looking at. And in terms of US dollar, the US dollar has been strong against most counterparties at present. This is US dollar CAD, which is sitting in a much wider, broader channel, but offered up this double top last week. And the double top sits between just over 130 and 125, but it's a sufficient range to actually trade this channel. So this is another one that sits there, just bubbling away, waiting for my system to trigger. In terms of bright spots for trading opportunities, a lot of things are, let's say, in transition. Robusta coffee is one of them, and it too is congesting sideways. And the range here is very, very narrow, so it's simply a matter of looking for the breakout in one direction or another and going for it in that particular direction. However, the point I would make about this is that if it breaks to the high side, there is still that double top from December and March to be aware of. There's not a lot of fat in there, but there is a lot of fat to the downside. In some of the commodities, you're getting a sell-off, which has begun in soybean oil, which my system picked up over the weekend and will go short on Monday when this market opens. The soy complex, along with corn, oats and the like, had been exceptionally good performers. But it does seem that that phase of the market is over. That way of doing things, that panic that had set in there has settled down, as most panics do. All things pass. And this is a lesson from this, is that whilst people are very myopic in the way they view markets, they jam themselves up against the screen and they worry about every changing colour from green to red, as if that's the end of the world. But in terms of the bigger picture, it is worth stepping back and trying to place things in a matter of context. And speaking of context, this is crude. The entire energy complex seems to be exhibiting this sort of pattern, with the exception of natural gas, which is at present a little bit like a mad woman's breakfast. We do have this channeling up towards the 123.5, 124 mark. And where it goes from there is anybody's guess, but it is a matter of being primed and ready for it. You'll notice there's no stocks in here. As I said before, I can't conceive of a reason why at present you would buy stocks. There simply is none. This notion of buying the dip, this notion of averaging down are simply stupid, and they don't hold up to any sort of rigour at all. But in terms of talking about markets, no market wrap is complete in any way, shape or form without the elephant in the room, Bitcoin. The supposed hedge against inflation. I suppose it is a hedge against inflation, but not in a good way. As I was putting this together, morning trade here on Sunday had Bitcoin trading at 18,300, which is a substantial decline. It does unfortunately look like there is still there's nothing to catch it between this 18,000 and 10,000. And if you look at, and if you are to believe in any way, shape or form, and I say take that with a grain of salt, the number of forced liquidations that are occurring in players involved in Bitcoin, it's difficult to see anything positive in this in the short or mid-term. But to return to a closing point, to take no action is an action. One of the things about markets is that whilst they are two-way, that two-way street enables you to be as passive or as active as you want. But the problem with being passive is that you end up often on the wrong end of the equation. You often end up on the losing end of the trade. And this seems to occur because there is this notion that people have that it is somehow, I won't say illegal to sell a stock, but somehow immoral, that you're not holding faith, that you're not sticking with your tribe, your group, whatever management term is used at present to describe a bunch of wankers. And you hear this and see this in Bitcoin. Bitcoin's a religion. It's nothing more. This is a religious view. And as such, you need to take it as a religious view, in that it is impossible to convince people within that religion that their belief structure is incorrect. And you need to take that as a given, but that doesn't mean you need to be part of that. And you don't need to be party to that sort of collapse and be stuck with this sort of event. I will be very, very dogmatic and say that if you're holding anything in this top half of this list, you can probably kiss that money goodbye. If you bought these stocks at their highs, then that money is gone. But you need to look at that. Yes, it is financially distressing. But what it actually does is it gives you a monetary value as to your ability gap. And the ability gap is the difference between where you could have exited and where you are now. And that ability gap has a dollar value. Well, one of the things I have learned over the years, that the easiest way to alter and modify your own behaviour is to actually give it a dollar value.